Hi, my name is Randy Bruns. I'm with Model Wealth. Today we are going to talk about politics and your portfolio. So, one of the things a lot of people are thinking about right now is, are there any changes I should be making to my portfolio given the fact that there's a presidential election this year? And the answer is no. There is no noticeable correlation to be found between political parties and stock market performance. Historically speaking, the US stock market has experienced incredible growth over the past 98 years, regardless of who's in office. And that's true no matter which party controls the House, the Senate, and or the presidency. Because shareholders ultimately invest in companies, not political parties. If you make an investment decision based on politics, that's going to be an extremely risky gamble. And a better approach is to invest in a globally diversified allocation that balances your ability to sleep at nights through its darkest days, also known as your risk tolerance, with the required return you need to achieve all of your financial goals. If we look throughout the last 98 years, 1926 to 2023, there have been Republican presidents, there have been Democrat presidents, and yet throughout all the years, the average annual return for the S&P 500 has been 10.28%. That would have turned $1,000 back in 1926 into $14.6 million today. If you look at the last 10 presidents, from Nixon in the late 60s, early 70s to Joe Biden through March of 2024, you can see a whole lot of really big returns, some negative returns, but there's really nothing to draw from any of these returns that should drive your investment experience. The bottom line is the stock market grows really, really big over the long haul, and it doesn't matter who's in office. If we look at the president's who is the president's party, does that affiliation matter? Let's just look at the last 98 years. When we had Republican presidents, there were 47 years where we had a Republican president. The average annual return for the S&P 500 was 9.32%. When we had a Democrat president, 51 years, the average annual return was 14.78%. That is a noticeable difference right there, but a lot of that has to do with just being in the right place at the right time. Bill Clinton, for example, was president, a Democrat in office during one of the biggest bull markets in history, the 1990s, and that was largely driven by technological advances and not necessarily who was in office. If you put all the years together, however, there's 98 years, 1926 to 2023. Again, a 10.28% average. If we look at the last 98 years, that 10.28% average, or $1,000 hypothetical growing to 14.6 million, well, that happened amidst the headwinds of some awful events. The Great Depression, attack on Pearl Harbor, World War II, the Cold War, terrorist attacks, civil rights marches, an assassination attempt, or a successful assassination attempt on a U.S. president. We've had terrorist attacks, the Great Recession, global pandemics, attacks on the U.S. Capitol. So, and then here's just a look at some of these popping up. And you might ask, well, how does the stock market perform that well in spite of all of those negative events and all that volatility? It's not an in spite question. It's a because answer, basically. The stock market averaged 10.28%, not in spite of all those negative events. It did that because of all those negative events. If investing in the stock market were easy, everybody would crowd their money into it and there'd be no return, little to no return left for any of us. So there's got to be some sort of financial incentive, which academics refer to as a risk premium. There has to be some sort of premium that investors receive to lure them off the sidelines from like a savings account or money market or treasury bills, or away from being a lender in the bond market, both of which are extremely safe relative to stocks. Well, a lot more predictable in terms of cash, and far more safe in terms of being a lender than owning a business. So there has to be some sort of incentive. And if you have long-term money, and by that we're talking about 15 or 20-year funds, and retirees, we're talking to you too, because you likely have a portion of your nest egg that's still 15 to 20 years away. But if you have long-term investments, you should accept volatility. You don't have to like it, but you should accept it, even maybe embrace it, because that volatility is why you get the big returns of stocks if you stay patient and keep your expenses low. If we look at, so we know the president doesn't necessarily have much of an impact on the stock market, but there are so many factors. The stock market is such a complex thing. You have interest rates, health crises, oil prices, natural disasters, technological advances, corporate activity, congressional actions. These are just a handful of countless factors that can influence the stock market. If we look at the stock market relative to which party controls Congress, you can see red are Republicans here. You can see blue are Democrats. Again, and then if you see any stripe lines, that's a mixed Congress. In other words, one party controls the House, one party controls the Senate. But again, the stock market has grown incredibly well over the past almost 100 years, regardless of who's in office. Let's get a little bit more into who controls Congress. If you have a unified Republican government, and that means the Republicans control both chambers of Congress, the House, the Senate, and the presidency. That's happened 13 years in history. The average annual return of the S&P 500 was 14.52%. When there was a unified Democrat government, that was 36 years, the average annual return was 14.01% for the S&P 500. If it was a divided Congress, but with a Republican president, 34 years that occurred, a 7.33% average. And if it was a divided Congress with a Democrat president, that was 15 years, and the average annual return was 16.63%. Not sure there's anything to gain or to find in those returns. Certainly not enough to drive an investment decision. If you believe that Republicans are better for one specific sector or worse for one specific sector, or Democrats better or worse, this shows all the different presidential election years going back to 1976, and you'll see sectors from energy, communication services, financials, industrials, consumer discretionary, consumer staples, utilities, technology, materials, healthcare. Blue are when a Democrat was elected president. Red are when a Republican was elected president. Underperforming years versus outperforming years. These are these sectors relative to the S&P 500. And for every sector, there's a mix of Republicans and Democrats on the outperforming side and on the underperforming side. This one, very little to gain. There's nothing to take away from this chart. If we focus on one particular time, now this is not necessarily political, but this is just going to talk about the risk of making emotional decisions. We're going to start on January 1st of 2008. 2008 was the worst year for the stock market since the Great Depression. And if let's just say you made a hypothetical investment of $100,000 on January 1st, 2008, 14 months later, at the end of February 2009, which was the lowest month end for the S&P 500 during the Great Recession, that $100,000 would have been worth just $51,550. 14 months later, your wealth is almost cut in half. That was a 48.45% decline. Now, I was actually experiencing that, and I witnessed a lot of people make some really emotional, really poor decisions, logical in their minds, but emotional. And it was. Let's just see how it ended up. If we just say, okay, how did things go if you invested that $100,000 that fell to 51.5 We have 16 years and 3 months since then. Let's zoom out a bit. Here is that $100,000 investment. There is the 51,500, and the dotted line is that lowest month end. And you can see things got really good since then. There was a lot of drama, a lot of political drama, a global pandemic right here, where the stock market fell 30% in a matter of weeks. Then you get the recovery, and then sudden unexpected inflation rises to its highest level in like nearly 40 years. That dropped the stock market and the bond market in 2022. Then we get a recovery. But over the entire 16 and 1/4 years, that 100,000 in the S&P 500 grew to $495,099, and that is a 10.34% average annual return, starting at a pretty awful time. And that's just the resiliency of the stock market. It's going to be dramatic. There are going to be awful events, but if you just sit still, and you got to make sure it's your long-term investments, long-term funds that you're committing to the stock market, and not anything you plan to use in the next 5 years or 10 years, for example. But if you sit still, you'll get the rewards of stocks. If we look at, well, what were the consequences of maybe selling on February 28th, 2009, when it fell to 51,500 or whatever. If you just waited 1 month, well, first of all, if you stayed invested, we know the hypothetical 100,000 grew to 495,000, the 10.34% return. But let's say you sat out 1 month and you got back in April 1st of 2009. Instead of 495,000, your portfolio by the end of March 2024 would have grown to 455,000, not 495,000, and you'd have lost about $40,000. You'd have turned a 10.34% average into a 9.78% average. Or when the dust settled, 16 and 1/4 years later, you'd have had 8% less wealth. If you waited 2 months, so you get out at the end of February, you sit all through March, all through April, and you get back in May 1st, 2009. By the end of March 2024, your sample or hypothetical 100,000 would have grown to 415,000 rather than 495. You lost almost $80,000 or 16% less wealth just because of waiting 2 months on the sideline. And if you waited 3 months, you got back in June 1st, 2009, your portfolio would have been worth $393,000 instead of $495,000. Your 10.34% average would have fallen to an 8.8% average. You'd have lost $101,642 because you were missing 3 months. And the end result was you have 20% less wealth at the end of March 2024. But because that 101,642 or that 20% isn't there to compound for future years, 10 years from now, you'll still have 20% less wealth. 30 years from now, you'll have 20% less wealth. Once you make these decisions, emotional decisions, whatever it costs you, whatever you miss out on getting back in, you'll always have that much less for the rest of your life. And so to recap, there is no noticeable correlation to be found between political parties and the stock market. Historically, stocks have experienced incredible growth regardless of which political party is in control. And that's true no matter who controls the House, who controls the Senate, and who controls the presidency. Shareholders invest in companies, not political parties. Making investment decisions based on politics is an extremely risky gamble. And again, the better approach is just to invest in a globally diversified allocation that balances your tolerance for risk and your required rate of return. We would tell you, don't worry about things that are out of your control. Focus on things that you can control. What are the fees you pay? How about taxes? Are you doing everything right from a tax perspective? Do you have a financial plan in place? Do you have the right insurance? Insurance in place if, God forbid, you lose your you lose your job due to you lose your ability to work due to a debilitating disease, or let's say you die prematurely. Does your family do you have enough term life insurance? Do you have a sideline cash reserve in case you lose your job? These are things you can control. So to put it all into perspective, that's kind of the things that we are focusing on. Build yourself a financial plan. Turn off the news for your long-term investment money. Politics, yes, you hear about them all the time. Your friends, your family. You can't turn on the news without hearing something about politics lately. But it does not affect your long-term investments. If you want more information, you can find us on the web at modelwealth.com. You can email us at letschat@modelwealth.com, or you can pick up a phone and call us at 630-381-1171. We hope you enjoyed this video.